Let us see our next question. From following information, prepare, highlight the portion. Income statement of the company A. Information is provided about margin of safety is 20%, amount of interest is 3000, profit volume ratio is 25%, DFL is 4, and income tax rate is 45%. Dear students, over here in this question there is a new point provided to us, margin of safety. I just give you a small explanation with respect to the margin of safety. Margin of safety is a point which you study very much in detail in your costing. Margin of safety is a word which is connected to the break-even sales. Suppose, for example, actual sales of the company is, for example, 60,000. Break-even sales of the company is, for example, 48,000. Means actual sales is more than break-even sales by rupees 12,000. So margin of safety is rupees 12,000. The term break-even sales stands for the level of the sales at which there is no profit, no loss. Break-even sales means the level of sales at which there is no profit slash no loss. So coming back to the point, let us say that the actual sales is 60,000, break-even sales is 48,000, and margin of safety is 12,000. So this margin of safety can be calculated in percentage term like this. 12,000 rupees is the reduction in the sales that I can afford before, say, have loss in the business. So 12,000 divided by 60,000 into 100. So the answer comes to 20%. And that is what we understand is the term margin of safety. So over here we have been provided with such kind of information, and based on that, say, we are required to prepare the income statement for company A. I request you to do answer and put your answer in the chat box. Just write on a small note before we proceed further. First point, break-even point means level of sales at which profit is a zero. Second, margin of safety means excess sales over break-even sales. Full stop. Write down formula. It is sales minus break-even sales. This is in the rupees term, and sales minus break-even sales upon sales once again into 100. That is measurement in percentage term. Write on this much note before you do answer on your own. Friends, over here the question says that so you're required to prepare the income statement. What does it mean? It means that so you're required to calculate that what would be the sales, what would be the variable cost, what would be the contribution, what would be the fixed cost, what would be the EBIT, amount of interest, earning before taxes, income tax rate is given, so earning after taxes. You have to prepare a statement like this, and that is what say we understand is asked to us in the question, that is preparation of the income statement. Let us understand that say how to calculate the answer. The question is providing that say the margin of safety is 20%. So we understand that say, let us say that say the break even. Suppose the sales is X. Suppose margin of safety is 20%. So X minus 20%. At break even point the sales is 0.8x. Amount of interest is 3000, that is going to remain same. Profit volume ratio is 25%. So this is 0.25x and this is 0.20x. Financial leverage is 4. So this information is going to be useful. DFL is 4. So the DFL information along with the interest, this information will be useful to calculate EBIT. So DFL is EBIT upon EBT, that is EBIT minus interest. So DFL is 4, this is X, let us say this is Y, Y minus 3000. Y minus 3000 is transferred on the opposite side. It is 4y minus 12,000 is equal to y. 4y minus y is equal to 12,000. So 3y is equal to 12,000. Y is equal to 12,000 divided by 3. That comes to 4,000. So this is 4,000. This is 1,000. At break-even point, profit will be 0. Okay. Now the important point of the question starts. Income tax rate is 45%. So earning after taxes will be 55%. 550. Now understand carefully what I am going to speak. See over here, we can say something like this. There is a change in the contribution, and because of that, so there is a change in the operating income. Fixed cost is going to remain same, whatever may be the amount. So we can say something like this. Listen me carefully. Calculation of sales. It will be found like this. Change in contribution is equal to change in EBIT. So it is 0.25x minus 0.20x is equal to 4,000 minus 0. So over here we understand that so there is a change by 0.05x, and because of that so the EBIT changes by rupees 4,000. So as far as 0.05x is concerned, it is reflected in 4000. So x is 4000 divided by 0.05, that comes to rupees 80,000. So the sales of the company is 80,000. This is 80,000, and accordingly we are required to prepare the revised statement. This is what we understand. So friends, we understand and say, and this is what in detail for understanding. I request all of you to start calculating, writing answer from here. Working note number 1, calculation of earning before interest and taxes. Please, please write down answer. So write down answer. It is 4,000. Now write down further. Suppose existing sales is rupees X, comma, then existing contribution is 0.25x. Full stop. If sales reduce by 20%, it reduces to 0.8x, comma, at that time contribution is 0.2x, and profit, in bracket write down EBIT, will be 0. Full stop. So friends, I have dictated this portion to you. This entire portion which I have explained to you via table is explained to you. That is say I have dictated that to you. Let us assume that say right now the sales is X. So contribution is 0.25x. Sales is falling by 20%. So what will happen? So this is the revised contribution. In that case, so the profit which is right now 4,000 will reduce to 0. So write down sales, in bracket I am writing value of X. Change in contribution is equal to change in EBIT. So 0.25x minus 0.20x is equal to 4,000 minus 0. So X value is 80,000. Okay. So we have made the calculation of the value of the X. Now finally, preparation of income statement. In that write down column number 1 particulars, column number 2 answer. In that sales, it is an amount of rupees 80,000 less variable cost 75%, that is 60,000. Difference of both of them is contribution. Amount of contribution is 20,000. Less fixed cost, that will give EBIT. Amount of EBIT is 4,000. So the fixed cost will be 16,000. This is 16,000 found balancing figure. It is 20 minus 4. Less interest amount. Amount of interest is 3,000. Earning before taxes 1,000. Earning after taxes 55 percentage. It is 550. Please write an answer. So small revision of the entire question. There is a point that say we have the margin of safety. Margin of safety is a word that you are going to use in detail in your very simple like the subject of the costing. In that say there is a connected word called break-even sales. Suppose the actual sales is 60,000, break-even sales is 48,000. So margin of safety will be 12,000. Margin of safety is indicating the amount by which the sales reduces, and at that point of time you reach to the break-even point. So if at all the sales reduces by an amount greater than that, then in that case there will be a loss. So it is 12% in this example. Break-even point means the level of the sales at which the profit is zero. Margin of safety is say indicating the excess sales over the break-even sales. So in amount term it can be calculated as sales minus break-even sales, and in percentage term it is like the margin of safety upon sales into 100. Existing sales is X, contribution is 0.25x. We don't know what is the fixed cost. However, we have computed that EBIT is right now 4,000. Sales reduces by 20%. Contribution will also reduce by 20%, and at that point of time profit would be zero. So change in the operating income by 4,000 is reflected by change in the contribution by 0.05x. Accordingly, we make the calculation of the x, and that is what we understand is say 80,000. Then we have prepared the entire working of the income statement. Sales variable cost is 75% because the contribution is 25%. EBIT is 4,000, so the fixed cost is 16,000. Minus interest 3,000, so EBT is 1,000. Minus 45% tax, so EAT is 55,000. That is what we understand.